Hey everyone, welcome to my very first video, and today we're going to be talking about credit spreads, specifically put credit spreads. This is a strategy that I love. I've been using it a lot recently, and I've done pretty well with it. As you can see, in the last month I made 46, almost 47%. However, that's me being very aggressive with the strategy. Using the strategy in a safe manner, I don't think it's unreasonable to aim for around 5% return per week. I think that's totally achievable with an acceptable level of risk. So if you don't know what credit spreads are a theta gang strategy. And what a theta gang strategy is basically you're selling options to people on the market who will buy them, and you are collecting premiums. And they're called theta gang strategies because you are taking advantage of theta decay and you're turning time into money. So before you get into the strategy, I'd say it's a good idea to really understand puts and calls. You don't need a ton of background information to start trading with this. That's kind of the point of this video, is there's a lot of resources out there, but I kind of want to put everything together, make it really simple for you to go ahead and start using this strategy to grow your account. So with theta gang strategies, you are turning time into money. You're taking advantage of theta decay and you are keeping those premiums. So when you sell an option, you sell it at a premium. The buyer pays the premium for the contract. You as a seller get to keep that premium. And if the option expires worthless, all that premium is yours to keep. And selling options can be very profitable, especially right now when implied volatility is really high. We can go and check out some of the premiums on some of these stocks like Amazon. So if you were to sell an Amazon put right now at the $3,400 strike price, you would be collecting a premium of $6,130. Yeah, that sounds awesome, right? However, if you're selling a put just outright like this, by the way, we call that selling a naked put. If you're doing it with a call, we call that selling a naked call. And yes, you can make a lot of money by doing this. However, the risk you're taking on is insane because you're essentially being prepared to be assigned. And what that means is give up 100 shares of your stock at that strike price. So let me show you what that looks like. Here we got Amazon, and this is optionsprofitcalculator.com. Absolutely great website. I love it. I use it all the time for my trades, and I'm just going to use it here to show you what writing an option looks like and the sort of risk you're inheriting. So this is the 3,380 strike price. The price per option, those are the premiums, are $111.93. So the credit to your account is going to be $11,193. So that sounds great, right? You're taking on $11,193. That's your money. However, the risk is absolutely insane. And now, granted, that's at a price of zero. So if Amazon trades all the way to zero, you're losing absolutely insane amount of money. Now, that's really unlikely to happen, but it's still risk. It still can happen. And we'll go down to this graph here and show you what kind of loss you can see. So Amazon doesn't even have to trade all the way to zero for you to lose money. You know, it can drop down to 31 whatever and you're still losing money there. Now granted, you can still make a lot of money, you can still lose a lot of money, and you can lose all of your money. So what if you want to sell options but you don't want to take on that kind of risk? That's why credit spreads are awesome, because you're selling an option but you're also buying one right below it, so you're capping your risk. Now you're also capping your gains, but it's absolutely worth it because you're not risking hundreds of thousands of dollars. And you also don't need an insane amount of capital to start. If you're going to sell this Amazon put here, you need to have the capital to back 100 shares in case of assignment. Now with credit spreads, I do recommend having about $1,000 in your account because you're going to need to have capital to back your trades, and Robinhood will hold it as collateral. You'll see that once we put together a trade here. So let's just get right into it. Let's put one of these things together and I'll kind of talk you through it. So let's go back down to Amazon here. And let's go to Amazon options, and we're going to be building a put credit spread, which is going to give you a bullish position. And what that means is you want the stock to go up, you want the stock to increase in price, and even it can trade neutral. It cannot increase, it can stay at the same price, and you're still going to be collecting money from that theta decay. What that looks like is right here back on Options Profit Calculator. I've already loaded this one out for the credit spread we're going to be building. See, we have this 18th September expiration, 3,300 put. That's our long option. That's what we're buying. Our short option, the one we're selling, is our 18th September expiration date. Strike price is 33.05, so it's right above it. You can see the premium is a little bit more. So this is the credit we're taking on from selling that option, is $79.50, and then we're paying a debit on the option that we're buying. So that's going to result a net credit of $212 to our account. And this is what the graph of that looks like. See, that's awesome. It's not like a call graph, which is right here. You know, you buy a call for Amazon, and if that underlying stock doesn't go up, and it doesn't go up quickly, you're losing a lot of money. So let's go back to our credit spread here, and you can see it's trading neutral. You're collecting those premiums. You're making money. It goes up. You know, you're in a nice bull market like we are now. You're keeping those premiums. It's a very good way to grow your account in a neutral market or a bull market like we're in right now. So let's go back to Robinhood. Let's keep putting this together. So we're under the Amazon contracts expiring September 18th. We're going to be selling the 3,305 strike, and then we're going to be buying the one just below that. And what we're doing here is we're selling this option, but we're hedging it with buying the option right below it. So even if Amazon goes below $3,305, this option here, the $3,300 strike, that is covering us. That is mitigating our risk and keeping us safe. And the total risk you're taking on with this position is the difference in strike price minus the credit received. That's the total amount of money you can lose in this trade. And you can see that the credit we're taking on is $2.13, or $213, because options are 100 shares each, so $2.13 times 100 is $213. Go ahead and review order, and we're going to be taking on a credit. We are selling the 3,305 strike for a credit to our account of $7,950, and then we are buying the 3,300 strike for a debit of $7,738. 7,950 minus 7,738 is $213 that will be credited to our account. So that's a credit. We are selling to open the 3,305 put, and we are buying the 3,300 put. So the contract we are selling is greater than the contract we are buying, which means we are net selling to open. So you'll go ahead and hit submit. It may take a few minutes for it to fill, but that's just because you're executing two contracts at once. So I'll just cancel that and take us back home, and I can show you what happens once you have one of these filled. So I'll go to my Amazon spread that I currently have open, and you can see that its current value is $108. I opened it for a credit of $168. That means my total return is $60. If that doesn't quite make sense to you, let me explain it again. So I took on a credit of $168. That was my sell to open. I sold this position to the market for $168. To close it, I have to buy it back. Now it is worth $108, which means my profit is $60. And when you're opening these positions, it's good to look 21 to 45 days out. I find that's when premiums are at their best, and then you're going to close at 7 to 10 days to expiration, or at 50% max profit. I like closing at 50% max profit because then you can reinvest your profits and open up a new position, and it's just the best way to keep your account growing. So I hope you guys have a good idea of what's going on with put credit spreads. You can do the inverse of this with calls, and that'll give you a bearish position. I'll make another video about that later. But go ahead, put your questions down below. I'll do my best to get back to you and answer them. Go ahead and click the links down below if you want to sign up for Robinhood, WeBull, get some free stocks, get some free money. Get out there, have a good weekend. Catch y'all later.